In the previous lesson we covered the introduction to market structure and the two main theories, the Wyckoff theory and the Dow theory. We're going to cover the Wyckoff theory more in depth in another separate video or a separate series because it deals with higher level concepts. The Dow theory we're going to cover more in depth now because it is the most relevant in identifying a trend on any time frame and without the need of any extra analysis to it. So what we have in the market structure is two key terms which I want to cover first before we move any further. They are break of structure and market structure break. Put very simply, a break of structure is what you mark when a trend continues. So in an uptrend, when it makes a new high, that is called a break of structure. In a downtrend, if it makes a new low, that is a break of structure. And for a trend reversal, so when one trend ends and the next one begins, that is what you call a market structure break, or a market structure shift as some people call it. So break of structure, as you can see on the chart here, you look at it and it's easiest for everyone to measure it on a line chart. It probably looks clean to you, especially if you're not very familiar with how charts work. So you take the high. Whenever the line closes above that high, it is marked as a break of structure until it sets another high. And once that high gets broken and close through, it sets another level. These are breaks of structure. When the low, which led to the highest high, gets broken with a line closing through it, that is called a market structure break. Because as you can see, the uptrend, the Dow theory relevant trend of higher highs and higher lows has been broken, and we've made a lower low below the previous trend. Now looking at it on the line chart is okay to get a grasp of what's going on, but looking at it on a candlestick chart is essential for trading because you need to have what's known as confirmation. So this is the very same chart zoomed in with the same break of structure marked. So here, because the candles deal with wicks as well as closes, you want to draw it across, and whenever there is a candlestick which closes above the line, your actual confirmation is here. So you will notice that the level of break in the structure is not the level where it is confirmed. The confirmation will usually be higher than that, based upon the candle close. The reason for that is because if you look at these wicks, if you don't wait for the candle to close, you can incorrectly mark a break of structure. Like these were incorrectly marked as breaks of structure because they were only the wick. The candle body did not close above them. When the candle closed through it, you then mark it as confirmed break of structure, and in this case continuing the trend. And on the way down, when this candle closed below the red line after it closed, there you mark it as confirmed market structure break, identifying a possible trend reversal. So that's it, break of structure and market structure break. Same for uptrend and same for downtrend.